guys, welcome to another video, and in this video we are going to talk more about options. The first thing that we are going to discuss is premium price. How the premium price of an option contract is determined. So there are two constituents that make up the premium price, and these are the intrinsic value and the time value. Intrinsic value is determined by stock price minus the call strike price. So stock price is 1333 and strike price is 1320. So 1333 minus 1320 would give you 13. So the intrinsic value is 13 rupees. All right. So 13 is the intrinsic value and rest everything is the time value. So 70 minus 13, that would give you 57. So 57 is the time value. So the month has just started. That is why the time value is so high. First, let's talk about intrinsic value. As you can see, one of the variables of intrinsic value is stock price. Whenever there is a movement in the strike price, the intrinsic value would change. Whenever the stock price goes higher all over, the premium price would go higher all over, because stock price is one of the constituents of intrinsic value. But when you talk about time value always decreases. So time is always an enemy of an option buyer. So as the day passes and it comes closer to the expiry date, the time value keeps on decreasing. So if it's in the last week of the expiry, the time value would decrease significantly, making your premium price go lower very fast. So for an option buyer, intrinsic value is your friend, whereas your time value is the biggest enemy. So whenever people buy option contract, they tend to forget time value, because suppose you bought an option contract of Infosys when it was going on, say, 1330 rupees, and the strike price that you bought was 1360. Suppose the expiry date is very close, say in the next 2 days, the price has touched 1350. So if you think logically, you should have made profit, because there is a 20-point increase in the price from 1330 to 1350, but there is a huge chance that you would probably be making losses because the time value is against you. So even if the stock price went up, you might make losses because you are closer to the expiry date and the time value would keep on decreasing. So whenever you are buying an option contract, make sure that you not only analyze the price movement, but also the time frame, as in by what date you will achieve that particular target. Having said that, let's discuss how you can make money using options, as in what all are your options. So basically, whenever the markets are going up, you buy a call option. Whenever the markets are going down, you buy a put option. But this is a point of view of the option buyer. Suppose you're an option seller, you do exactly the opposite. So whenever the markets are going up, you sell a put option. And whenever the markets are going down, you sell a call option. In both ways, you will make money. All right. Now, let's look from the perspective of an option buyer and an option seller. So as I said, whenever you buy an option, if the market goes in your favor, you make profit, right? Suppose you bought a call option of Infosys. Suppose the price was going at 1335, you bought at the money 1340, the price touched 1360, you make a lot of profit. The price goes even higher, you make even more profit. So basically that means an option buyer can have unlimited profit. All right, the higher the price goes, the more the profit you make, right? Now suppose if it does not go in your direction, what is the maximum amount of loss that you can make? That would be the premium price. Suppose you paid 60 rupees for a lot of 600 for Infosys. That is 36,000 rupees, right? So even if everything goes against you, the maximum loss that you can make is 36,000 rupees. That is the exactly the premium price. But if everything goes in your favor, you can make unlimited profit. All right. That's for option buyers. Whereas option sellers would have exactly the opposite. Suppose you sold an option contract and whoever bought the option contract went in their direction, as in it went against your direction. You can make unlimited loss. But if it does not go in the option buyer's favor, as in because you are the option seller, the maximum profit that you can make is the premium price. Whatever the premium price is going right now, and the more it decreases, that is the profit you make as an option seller. So basically, an option buyer has unlimited profit and limited loss, whereas an option seller can have limited profit but unlimited loss. So this would make you think that it's always smarter to buy options rather than selling options, but no, there is a twist here, right? If you look into statistics, usually option buyers are facing losses, as in around 70% of option buyers are generally facing losses, whereas option sellers, 90% of the time they are having profits, and it's very rare that option sellers get a loss. This is because the time value. So, as an option buyer, the markets can go in your direction or against your direction. Even in option seller, the market can go in your favor or not in your favor. But one thing that would always be with you is the time value. So, as an option buyer, time value is your enemy, but as an option seller, time value is your friend. And no matter what happens, time value would always pull the price down unless and until there is a very huge change in the price, and if the luck doesn't favor you at all, that is only when the option sellers make losses. But that also means option sellers would require a very high margin to sell any option, and the profit that you make would be very limited. So that basically means that you will have to put in lakhs of rupees to make a very few thousand rupees profit, but those profit would be almost guaranteed to you. That's the difference between option buying and option selling. So this would be it for this video. In the next video, we will talk a bit more about options. Till then, take care, stay tuned, keep watching. Cheers. Bye.